The Genius Act is just a Trojan horse for a CBDC, unfortunately. In this video, I'm going to talk about why. I'm going to break down the different types of stablecoins, at least the most popular ones, how they're different. I'm going to break down the Genius Act, and I'm going to show you guys how history doesn't repeat itself, but it often rhymes, as this isn't the first time that banks were able to issue their own form of dollars. And then stick around to the end of the video because I'm going to tell you guys how I view this long term, how I think it'll unfold, and what this can actually do for the dollar and the United States remaining the world reserve currency. So this is going to be one of the most important videos you ever watched. I spent a lot of time researching this. So let's get into it. And per usual, none of this is financial advice. So before we get started, I do have to say we did an in-depth video on why stablecoins are crypto's killer app on the Know It Alls channel. Click the link in the description to watch that video. Definitely give that video a watch if you haven't. We looked at Tether and USDC, look at their monthly attestations, what they're backed by, how they work, and why they generate so much money. Okay, so the first type of stablecoin is fiat collateralized stablecoin, and these are usually backed one-to-one by different assets, whether it be US dollar deposits, mostly US treasuries, commercial paper, some Bitcoin held in reserves, and they get audited on a monthly basis. So the most popular ones are Tether and USDC, which is a stablecoin issued by Circle, which is now a public company. You also have BUSD, which is Binance's stablecoin. You have TrueUSD as well. So these are some of the popular ones. The second type are crypto collateralized stablecoins, and these are backed by cryptocurrencies, often over collateralized to offset volatility. So some of the most popular ones in this category are DAI from MakerDAO. In the beginning, $1 of DAI stablecoins was equal to $2 worth of ETH. But now they also have commercial papers and all these other things. It's just like the banks. Like eventually they start one-on-one, but they start realizing like, oh, I can do this. People aren't pulling out. And, you know, they eventually end up holding all types of other things to where they can get a yield from the money that you use to buy the stable coins and not pass it on to you. Okay. So like when you go on Coinbase and you purchase USDC, you get a stable coin, keep your real dollar. $1 equals $2 because $1 came out of thin air. And now they take your dollar and they go speculate on it with US treasuries and Bitcoin and other things. They get a yield or a return, and then they don't pass it on to you. You also have SUSD, which is synthetics, LUSD, which is, you know, also ETH backed. And then the third most popular are non-collateralized algorithmic stablecoins. Okay, so they maintain the peg via supply and demand adjustments. Incentives are algorithms. Frax is the most popular algorithmic stablecoin. Most of the other ones kind of went away. And basically how it works is that it's partly collateralized, partly algorithmic. So unlike USDC, which is backed, you know, with different assets, or USDT, Frax is a hybrid. So some of each Frax is backed by real assets like USDC, and the rest is stabilized by an algorithm. So when Frax is trading above $1, the protocol says, hey, cool, people want more Frax, let's lower the collateral ratio. That means less backing is needed, relying more on the algorithm. But when the Frax is trading below $1, the protocol raises collateral ratio, meaning more is backed by stable assets, giving it stronger support. And then they keep things balanced by arbitrage. So if Frax goes above $1, so let's say $1.02, traders can actually mint Frax at $1 and sell it for $1.02, making a profit. And then that extra supply pushes the price back down. And if Frax goes below $1, say 98 cents, traders can actually buy it cheap to redeem it for $1 worth of assets, which shrinks the supply, pushing it back up. Okay, so this is the algorithm. It's like minting and burning. And the result is that it stays around that $1 area. Okay, so now before we dive into this, I want to talk about the Genius Act, and I want to give some pros and cons to it. And I want to mainly talk about its inflationary implications, okay? So basically, the Genius Act is a bill that passed by the President and the Senate and the House. It's in full effect, and it basically allows banks to issue their own stable coins as long as they have a reserve backing of US Treasuries. So it's forcing banks to buy more US Treasuries, and it's going to be very inflationary, right? I always like to say, any kind of recession or depression that we've ever experienced in the economy, it can always be traced back to the Federal Reserve making it easy to borrow money in some subset of the economy, right? In the Great Depression, it was really easy to borrow money to finance applications and cars when people were coming home from the World War. In 2008, they made it extremely easy to borrow money for a mortgage. right? If you haven't, go watch The Big Short. There's a scene in there when Steve Carell was knocking on people's doors, basically trying to get to the bottom of the situation. And he knocked on this one guy's door asking for his name. And the guy's like, why are you asking for my neighbor's dog name? So they made it so easy to borrow money to get a mortgage that you could take out a loan in your dog's name, right? And keep in mind, you need social security numbers, bank statements, address, like literally all the most sensitive information, and you still are able to get it in your dog's name. So that shows that they weren't really checking, and they just wanted to get the money out there to stimulate activity. And then during the pandemic, they made it really easy for corporations to borrow money. Hence the PPP loans and the EIDL loans. We all know a friend who never had a business but got a business loan through the PPP loan because they made it super easy, right? This time, they are printing money through the Genius Act. And like I said before in the video, when you go on the exchange and buy USDC, $1 equals $2 out of thin air, right? Because you're taking your actual cash, you give it to them, they give you USDC, they still have your cash, now you have USDC. It started with the dollar, now it's $2. So if $1 trillion in stablecoins gets bought up, that equals another $1 trillion. So it's going to be inflationary, and the people who lose are going to be the people who don't put their money in a place or vehicle whereby it appreciates faster than the inflation rate. Okay, so like for example, if you're in a treasury bond that's paying 5% annually, but inflation is 10%, your real yield is negative 5% because inflation is 5% more than what your bond is paying. Okay. Now, if you want to learn where to put your money in DeFi to get yields that more than outpace inflation with a group of professional coaches, right now we're doing our 49 Weeks to Freedom Challenge led by our coach, Chris. We're calling out the liquidity pools that we're getting in. We're hopping on a call every week to track it. All the calls get recorded. And we always tell you when we rebalance, when we get into a pool, when we exit a pool, great support, all the tools and resources that you need. Have a really vibrant community that's growing more and more every day. And I like to think that we're preparing our members very well for the bull market. So if that sounds interesting to you, you can book a free strategy session with me to see if our program is a good fit. Link in the description. And 3, join our free community to get the lay of the land. Okay, I digress. Let's go over the pros and cons of the Genius Act. Okay, so one of the pros is mainstream adoption and approval. Okay, these are banks issuing stablecoins. It's going to get people comfortable with using blockchain technology. It's going to get them hooked. Right, and this is part of the Trojan horse CBDC that I'll get to a little bit here, but it's just going to get people comfortable with operating on chain, and more importantly, operating on chain without even knowing that they're playing on chain. I think it's going to create some cool incentives around ETF integrations, right? There's going to be some banks that have ETFs and stablecoins, and they're going to be able to create cool incentives to where like, oh, if you purchase the ETF with the stablecoin, maybe you get a lower annual fee, or maybe you get a lower interest rate on your loan, or, you know, the possibilities are endless. But we're going to see a lot of incentives because all these banks are going to be issuing their own stablecoins. So they're going to have to figure out different ways to be competitive. And another pro is that it's going to unlock more transparency, right? Because they're going to be annual audits and disclosures. So you're going to know what they're doing with your money. And you won't see everything that the bank is doing because they're still going to have products outside of stablecoins. But it'll be harder for them to pull a old doozy on us, right? And another pro is that I think it's going to increase liquidity and activity in DeFi. So the people who are in DeFi and know what they're doing, it's going to be increased liquidity that goes into it so that it'll be more opportunities to make good yields. Okay, now let's go over some of the cons, okay? And these are big. The biggest one I think is that these banks are moving way too fast, right? So we already talked about how it's going to be inflationary. But if you watch the video on why stablecoins are crypto's killer app, is because they make a crap ton of money. Tether is the most profitable company in terms of their employee to revenue ratio, right? They make the most amount of money with the least amount of employees, because when you do that stablecoin, right, you're essentially taking free money from someone. You don't have to pass on a yield. And then it's essentially just getting free money to invest with, right? And not only that, you make transaction fees anytime these stablecoins are moved, okay? So I think because of that, a lot of banks are going to want to have their own stablecoin because it's another revenue stream. But I think they're going to move too fast, and there's going to be security issues. There are going to be depegs. And if one depegs, people are going to get scared about all the other ones, and it's going to cause people to probably flee to USDC and USDT, okay? So a lot of people, I think, are going to lose money. And I don't plan on playing around with all these stablecoins. And hey, they'll probably have like some kind of FDIC insurance. So like, you know, JP Morgan stablecoin is going to be more safe than your credit union or some other smaller institution that isn't as well capitalized. Okay, so it's going to be like when a bank fails, they get swallowed up by a bigger bank, right? Another flaw is that it's no yield directly on the stablecoin. So the Genius Act actually prohibits issuing interest or yield on stablecoins directly. So that means banks can't use them like savings accounts or yield products. And this was one of the ways that the crypto world and the bank world had to compromise, right? Because we all thought we were going to get yield-bearing stablecoins, but I think the bank did this to essentially protect their competitive edge. Because like if you have a stablecoin and you're paying out a yield, all the money is going to run out of banks. Well, not all of it, not our grandmothers, but it's going to cause a huge outflow. So the fact that these stable coins are going to just be like regular dollars and you can't get a yield, that doesn't mean that you can't stake the stable coin with the bank and they can pay the yield in some other way. But yeah, that is a con, right? We were all hoping for yield paying stable coins because it would make USDC and USDT more competitive. Because if one's paying out a yield, they're all going to pay out the yield and they're all going to have to keep raising their yields to stay competitive. Not good for them, but good for us. But that's not a thing. So it's definitely going to limit how attractive the stable coins are, which is good because I'd rather get my yields in DeFi. Another con, they're going to be able to freeze your account and funds, right? The traditional infrastructure that we're using for our banking isn't optimized to do that. But with stable coins and blockchain technology, they're going to be able to freeze your accounts. Now, this is good and bad. It's not just a con, because if there's some kind of hack or theft, they'll be able to freeze the account from the people who did it. But they can also just freeze your account for whatever reason they want. Now, let's talk about how I think that the Genius Act is a Trojan horse for a CBDC. Okay, I think their hidden motive is that they want to create a problem so that they can be the hero with the solution. And the United States has a history of doing this. If you look at the Great Depression, it was 4 major things that came out of that they wouldn't be able to get past without people being in so much pain. The first one, and this is in no set order, the Glass-Steagall Act, which has been rolled back, and it's what separated commercial banks from investment banks. So now like they can't just be wilding when you got a checking account, buying crazy stuff, right? The second thing was the SEC. The Securities and Exchange Commission came out of the Great Depression because people were buying stocks that were going to zero. So they called for some kind of regulation, what made something a security so that, people weren't losing money, right? But if they tried to do that beforehand when people were making money, wouldn't have passed so easily, right? The third thing was the FDIC, the Federal Deposit Insurance Corporation. And they brought this into play because these banks were going down, companies were going down, and people weren't, made whole. So they wanted some kind of insurance so that people felt comfortable investing, because people after the Great Depression, they weren't investing into the stock market for a long time, which brings me to the fourth thing, which was 401ks. 401ks were created because, like I said, people weren't investing into the stock market because people had lost so much money or knew people who had lost so much money. So they had to come together and be like, all right, we'll match you. If you save this or invest this, we'll match you with this so that, people can have some kind of incentive to invest again. Now, I'm not saying these are all bad things. These are good things. Like I believe the SEC is needed. Yeah, nothing's all good, nothing's all bad. It definitely has its downfalls and it can stifle regulation. But if there is no police, right, it makes it harder for institutions definitely to get involved. And we want institutions to get involved in crypto because we want to make money, because they control the 3% of people control 97% of the money. Okay, now let's dive deeper into this. Why do I believe that that's their hidden motive? Like I said, history doesn't repeat, but it often rhymes. So from the founding of the United States to much of the 1800s, actually, banknotes in circulation were typically promissory notes issued by individual banks, not standard federal paper money like the US dollars that we use today. So the US Mint and Congress actually established coinage, which is the dollar as the unit, early on, but paper currency was actually messier. So the private note system created problems for commerce and trust, right? And accepting a note meant accepting credit risk of the issuing bank individually, right? Redeeming notes for specie could be costly, and specie is just a synonym for like silver and gold. All right, we'll call it precious metals to make it easy. So as you can imagine, counterfeits were extremely abundant, right? It became especially problematic with the as the national economy expanded and as the Civil War strained federal finances. Okay, so how did the United States move from private banknotes to a single national legal tender dollar? Okay, it was actually a very long process with lots of court cases. So there were congressional acts, wartime necessities, court rulings, banking acts, and later the creation of the Federal Reserve in 1913 also played a part. So let's talk about the Coinage Act of 1792. This established the United States dollar as the monetary unit and authorized federal coinage or money. Federal coins were just legal money, widely accepted. Paper remained largely private banknotes. Okay, so the Civil War from 1861 to 1865 actually pushed the federal government to finance the war with new monetary instruments. Okay, so you had the Legal Tender Act, which was February 25th, 1862. And Congress authorized the issuance of non-redeemable paper notes called United States notes, aka greenbacks, right? We still call dollars greenbacks. And the 1862 Act made these notes legal tender for most debts, allowing the governments to pay soldiers and suppliers without gold backing. All right, so the greenbacks were fiat in practice, not convertible to precious metal at issuance, and were necessary to fund wartime shortfalls. Now, the issue of greenbacks as legal tender was very controversial, and it triggered a lot of legal challenges. So now we're going to talk about the National Banking Acts between 1863 and 1864, and it's basically set up a system of nationally chartered banks authorized to issue national banknotes. Here was the novelty, the lure, right? So national banks had to buy U.S. government bonds and deposit them with the Treasury. Sound familiar, right? This is exactly what the Genius Act is doing. In return, they could issue national banknotes up to a percentage of the bond value, right? So that tied banknote issuance to federal bonds, standardized notes, and helped finance the government. So later in 1865, Congress actually imposed a tax, this is important, on state bank notes, which made it expensive for state banks to keep issuing separate notes. Now, this tax did something important. It pretty much drove out state banknotes out of circulation, consolidating the paper money under national control. They couldn't afford it anymore, right? So then you had these judicial battles over legal tender, the issuance of greenbacks, and the broader legal authority of Congress to make paper money legal tender produced Supreme Court litigation, actually. So you had Hepburn versus Griswold in 1870, and the Supreme Court initially struck down parts of the Legal Tender Acts as unconstitutional as applied to pre-existing contracts. So this put limits on Congress's power to make paper money legal for debts incurred earlier. So boom, now we're in the early 20th century and the United States consolidated its paper currency systems again, right? Now, before I dive into this, guys, there's a really good book called The Starfish and the Spider, The Unstoppable Power of Leaderless Organizations, I believe. And it talks about how the pendulum swings between centralization and decentralization in every industry. This is talking about how I did it in money. Like a good example is like if you look at the music industry. In the beginning, it was very centralized because you as the musician were the commodity. If you wanted to hear me play music, you have to be where I was. It was centralized. Then we had the advent of the teleprompter that made it decentralized. So you had all these record studios popping up to where you can hear the music in different places, decentralized. It became centralized again with the record companies, right? Warner Bros. And etc. So now artists are getting record deals and you have to actually buy it from them. So they make a profit. It became decentralized again with LimeWire and Napster, where you can like illegally download music. If you didn't have LimeWire, if you're born in the 90s, you're a millennial, you know what LimeWire is. You had to be there. MP3 player, right? Fit like 30 songs on that thing. Anyway, so boom, it was decentralized again, and the record companies were actually trying to sue LimeWire and Napster, but they couldn't. They had no leader. And then it became centralized again with the Spotifys and the Apple Music, right? And now it's in the process of becoming decentralized again with NFTs and being able to tokenize your music. And I'm pretty sure there will be companies that offer NFT services and they'll get centralized again. Like it just goes back and forth. So now, boom, going back to this 20th century, the US consolidated the paper currency systems again. So you had the Federal Reserve Act in 1913, right? They created the Federal Reserve System in 1913 and authorized Federal Reserve notes as its liabilities. So over time, these Federal Reserve notes became the dominant paper currency. And then gradually, federal action and legislation phased out separate national bank notes and made Federal Reserve notes the principal paper currency. by general circulation. So now, by the time the 1930s came around, national banknotes and other legal forms dwindled, and the Federal Reserve note became the primary U.S. paper money. Sounds pretty familiar now, yeah? Right? So now let's talk about the parallels. So in the 1800s, you had dozens of state banks issue their own notes, each promising redeemability. Commerce was fragmented, risky, and often unusable. And then the Civil War actually forced the government to step in, unify standards, and declare federal notes as legal tender. So now if you go to the Genius Act, dozens, potentially hundreds of banks and licensed entities may issue their own stablecoin, each promising redeemability into dollars. While these will be standardized in some ways, 100% backing, redemption requirements, disclosures, it still introduces fragmentation in the monetary landscape. So now, guys, you have to realize, history suggests that when you let multiple issuers of money compete, a few dynamics always emerge. One, you have confusion for users, which is, hey, which bank's stablecoin should I hold and transact in, right? Two, discounts or secondary markets if trust differs among issuers. Guys, Bank of America and JP Morgan stablecoin isn't going to be looked at the same way as some smaller bank's stablecoin, okay? So the ones that are not as trustworthy, they're going to develop like some kind of black market. It's highly likely where they'll trade at a discount. And this actually happened back in the day too, because there weren't any payment rails. So if you got banknotes from a far, far land and you're trying to transact here, you're going to have to pay a premium because, how are they they don't know when that bank's going to shut down. They don't know if they issued more money than they had in gold, which they did all the time. You had banks failing all the time. And there was no way to like send a wire or MoneyGram, right? So same kind of thing here. And then the third thing is that there is pressure for the government to eventually consolidate or elevate one uniform standard, CBDC. So now let me give you my short-term outlook for the next 5 to 10 years. The first thing is going to be an explosion of issuers, right? So I expect every major bank, JP Morgan, Citibank, Bank of America, Wells Fargo, plus big regional banks to issue their own branded stablecoins, like think Chase Coin or Citi USD, etc. We're going to see fragmented adoption, right? So merchants and platforms may pick preferred partners. For example, Amazon might cut a deal with JP Morgan, Apple might do a deal with Goldman Sachs, etc. And I can see them as being, some of them safe, but very boring, right? So the big ones will dominate the safe stablecoin market, wiping out shady offshore coins and probably putting huge pressure on USDC and USDT. I used to think that they want USDC to be the CBDC, but I think they really want to get it the fuck out of there, if I'm being honest with you. I think they want to have their own and be able to control it. And they're just using it as a case study and trying to make it seem like they're playing friendly with the crypto people because they're a huge part of the voting and a lot of things now, right? Like people are taking crypto serious now. So I think they're just, I think they're eating crow. I think they're just playing their role for now. Okay, so I see 2 stablecoin worlds emerging. Regulated bank stablecoins, trusted, boring, KYC heavy, and then DeFi native stablecoins, DAI, Frax, USDC, riskier, but permissionless and composable. And now that Circle's public, I think that if they just like say that they're illegal and try to do away with them, it's going to piss people off too much. I think they're going to do what they're doing here and have banks issue stablecoins and make the bank stablecoins more competitive, and they'll probably start bad mouthing USDC, talking and not accepting it for certain things. Probably not going to be legal tender, right? And whatever is declared legal tender, people will accumulate it and save in that medium through hell and high water, because that is going to be the medium that people have to pay their taxes through. And if you don't pay your taxes, you go to jail and get taken away from your family, which is everyone's biggest fear. So now, here's my medium to long-term outlook to 10 to 30 years. They're really thinking long-term on this, guys. And this is when the history repeat could kick in. So the first thing is consolidation pressure. So just like state banknotes were taxed out of existence to unify around the national dollar, I think over time, regulators may be in favor of one or a few federal stablecoins over a messy ecosystem of bank issued coins, right? Number 2, a potential for a Fed stablecoin like a CBDC. If adoption scales and the public gets frustrated with multiple brands of money, and if some are depegging and all these sorts of things, people will be begging and crying for a single neutral central stablecoin, either Fed issued or Fed backed. And this is exactly what happened in the 1860s with the National Banking Acts, right? Hopefully you guys can see how the same thing has happened again. I can see a possible erosion of DeFi stablecoins, right? So these DeFi native stablecoins like USDC, USDT could survive as shadow money. And state banknotes did this after 1865, but they were increasingly marginalized by regulation, taxation, or just lack of institutional support, because you do need that. And then the last one is bank versus government tension. So banks may fight to keep their coins alive because it keeps deposits sticky, inside their walls. But the government may eventually just decide that a federal digital dollar is basically cleaner for monetary policy and stability. So boom, big picture. History doesn't repeat, but it often rhymes. So just a quick little summary. In the 1800s, you had thousands of banknotes. Then you had chaos, depegging, closing down, shadow markets, Then you had consolidation. Then you had a uniform national currency. So you went from all these different currencies to the United States dollar. And now we have dozens of bank stablecoins, which is going to cause fragmentation, likely consolidation, and not just fragmentation, but chaos as well, right? Not all of them are going to survive and it's going to go smooth, right? A lot of them don't know shit about hiring good developers, right? What makes you think that if the smartest people in crypto are building apps and there are depegs and hacks, that it's going to be avoided on a bank and it's going to be on chain, so people are going to be able to see it. It's going to be harder to hide. So boom, chaos, fragmentation, likely consolidation, eventual CBDC or CBDC Lite. They might just roll it out, right? So hopefully that makes sense. The Genius Act might just be an intermediate step. I think it is an intermediate step, a bridge period that lets banks experiment, stabilize markets, and onboard the public before the government inevitably centralizes issuance under one banner. Fed coin or digital dollar, CBDC, right? Now that we talked about all that, hopefully that makes sense. What do I see this as the end goal? Why are they doing this? Obviously, they want control, but I think the goal is to increase control without causing a revolution, right? Without killing crypto, without killing the vibe, and more importantly, extend the dollar's reign. And this is their best chance to do that, right? You have people in third world countries who are wiping their ass with their money because tissue holds value more. Everyone wants to be able to get access to dollars, but without stablecoins, it's hard. You can literally spin up a MetaMask wallet and get stablecoins in a matter of, not that long, right? So now by doing this, they're actually forcing the world to hold our debt, which increases our global reserve currency status, okay? And there's never been a time where we had technology that could help spread one world's currency globally, not just to institutions, but to everyday people as well, as easy as blockchain technology allows with their stablecoin rails. So yeah, not trying to be all doom and gloom. It's a really good book called Money from Nothing, or Why We Should Stop Worrying About Debt and Learn to Love the Federal Reserve. And that's kind of the book that kind of planted the seed. And they were talking about how, all these banks back in the day used to issue their own dollars. And I didn't even know about that. We actually did a book review on the Know It Owls channel, link in the description, where we broke down the best points from the book. Definitely give that book a read if you're into reading. Learned a lot in that book. So yeah, if you want to be a part of a group that helps you prepare for this, right? We're in this for a good time and a long time, right? I see myself working on this for the remainder of my life, right? I want to build something that outlasts me, and our team wants the same thing. So like I said, click the link in the description. You have those 3 options. You can join our community for free. You can book a free strategy session, or you can sign up for one of our DeFi webinars, because DeFi is the best way to be able to access generational wealth. You may not be able to guarantee and pick the next 100x, even though I think we identified a few of those things, but you can guarantee get high yields as soon as you start. So with that, if you got value, like, comment, subscribe, share with a friend. But with that, thank you so much for watching. I love every single one of you who tuned in, and I will see you in the next video. Take care and trade safe.